Hello, how you doing? It's Gus Tucker, and we're here for Financial Freedom Fridays. Hope your week is going well, and that life's treating you good. It's good to see you all, and it's good to be here. We're walking through the book, The Power of Zero by David Knight, and it is all about handling our largest expense, which is taxes. And the last time, or the time you really don't want to be paying too much in taxes, is when you retire. Okay, because depending on your situation, your income is relatively fixed. Most of your taxed deductions are gone, and you could be even in a higher tax bracket than when you were working. So we don't want that to happen to you. So we want you to spend some time up front thinking about your tax situation so that you don't wind up in that situation where you're paying the government more in taxes in your retirement than you were when you were working. Okay, so we're gonna walk through this. We're gonna walk through this presentation, and we're reading the book The Power of Zero, and we're gonna go through chapters 4 and 5 today, and then we're gonna go through 6 and 7 next week. 4 and 5, we're gonna be talking about the tax-free bucket, the tax advantage bucket, and some things that are strategies that you need to think about. The purpose of this slide is just to say, hey, guess what? The cavalry's not coming. No one's coming to save us financially as individuals or as people. Okay, and we need to get on it, doggone it, to take our financial future in our own hands. What you see is from where you sit. I learned this years ago that your perspective has been developed by the people you hang around, the seats you've been sitting in, the rooms you've been sitting in. And if where you are in life right now is not where you want to be, then we got to change that seat. We got to change who we're sitting with and what we see, because our perspective makes all the difference. Everyone's got a worldview. We've got to take our cues from someone. I choose to take my cues from the Bible and the God of the Bible, which I believe is the best and only vantage point for you to learn from, because he's seated in the heavenly realms far above this world, and he sees the end from the beginning, and he's in control and knows how things are going to turn out. So wouldn't it make sense to have that person as your guide while you're here on earth? Something to think about. Bible, basic instruction before leaving earth. Okay, this is a journal that we're using. It's now November. Isn't it going by? We started this in October to December. This is a journal we're using. It's a 90-day journal. Now it's like a 45-day journal to really write down the insights that you're getting as you finish up the year to set your goals for next year. How have you done with your goals for 2023? If you had to give yourself a grade, what would the grade be? Okay. We want to make sure 2024 turns out better. And the way we do that is by spending time and planning a little bit better. Okay. We're going to cover this in 2024, but I want you to be thinking about this. The 4 levels of wealth: getting stable, getting secure, creating freedom in your life, and then creating abundance. And we're going to talk about those 4 stages. And then the 8 financial breakthroughs that are stages are areas that you're going to get in and under control and managed on your way to those 4 levels of freedom. 4 numbers we talked about: your monthly cash flow margin. Do you know what that is yet? Your total income minus your total expenses, that's your cash flow. And then your total income minus your total fixed expenses. Those are the things you have to pay no matter what. That's your non-discretionary cash flow. The difference between those 2 things are things we could afford to cut out of our budget. Okay? That makes sense? All right. We want to look at our monthly savings and our monthly investment. Investment is something I'm gonna invest for at least 5 years. Our savings and investment goal, I encourage you to have it be 30% plus. The poor save 10% or less of their money. The middle class between 10 and 20%. The wealthy 30% and more. Okay. The poor view money as something they need to pay their bills. Okay, money is what I use to pay my bills. The middle class, money is what I use to buy nice things, typically on credit. And the wealthy, money is what I use to make more money. Okay, what's your view of money? What's your view of money? Take a look at that. Net worth, what you own minus what you owe, and how's that changing over time? Include your home. Look at it that way, and then use it not including your home. What do you own? These are financial assets, real estate assets outside of your home, business assets, insurance assets. What do you own versus what you owe? Okay, and look at your net worth, and then your financial independence number. When you stop working for money, because I don't know what your view of retirement is. You need to define that too. But when you stop working for money, what age do you want to stop working for money? And then where would that money come from? Investment, business, real estate. Where will it come from? Okay, and then we got to reverse engineer that plan to make that happen. So here's the book, Power of Zero. I want you to pick this book up. The Power of Zero, The Power of Zero, The Power of Zero. Retire and pay zero in income taxes. That's the goal. Okay? That's the goal. And along the way, as we're growing our money and we're accumulating money, we're doing that in tax-advantaged, tax-free environments. Okay, so we talked about how income taxes, are they going to be higher or lower in the future? And why we said it was a four-letter word, math. Math says spending is going up, tax revenue is going down. They're going to have to raise taxes on the people who are now left to pay taxes to meet the needs going forward. In 1935, there were 42 people working for everybody on Social Security. In 1960, it was 5. 2020 is 2.6, and it's going down to 2, about 2 workers for every worker that's working. That's on retirement. 2 people working for everyone that's on retirement. And we started out, it was 42. 42 people were working for one who was retiring. And the retirement age was 65, and the life expectancy was 62. In other words, the government didn't expect you to ever collect from Social Security. Okay, that's how it was originally set up. Now, here's the thing. Wow, why do you think taxes are going to go up? Well, 4 programs, Social Security, Medicare, Medicaid, and interest on the debt are 70% of the taxes we bring in. It takes up 70% of the budget. Okay, what about defense? What about Homeland Security? What about Health and Human Services? What about parks? Yada, yada, yada. And then we have unfunded liabilities that aren't in the budget, but are sitting out there that we have to pay. Go to usdebtclock.org. US debt, clock.org, and you can see these numbers. It'll blow your mind. So it's a math problem. Taxes are probably going to increase because of increased spending and to cover the cost of our entitlement programs. Because people will be up in arms if they cut certain things out of the budget. And people wouldn't get reelected. So they're going to keep doing it until we can't sustain it anymore. Now, do you want the government taxing your retirement? And tax rates are low as they've ever been right now, but they've been as high as 90% in our highest tax bracket in the past. So there's 3 tax buckets: taxable, tax deferred, and tax advantage. Okay, those are the 3 tax buckets. We talked about those. These are the types of accounts that are in those tax buckets. Savings accounts, certificates of deposit, bank CDs, money markets, stocks, bonds, mutual funds. Tax later, 401ks, 403bs, any kind of plan that has a 4 in it, 457, 403, 401k. You get a tax break now, but you're going to pay taxes later. And then tax never. Those are things you've paid taxes already. You invest them after tax. They grow without being taxed, and you can use them without being taxed. Okay? And I would suggest to you that that's the tax bracket you want to be in when you retire, so the government's not taxing your retirement. Does that make sense? I hope it does. So we talked about the taxable bucket strategy. That's that first bucket. This first bucket, We only want money in there that we're going to need to use in maybe the next 6 months. You want 6 months of living expenses or 6 months of income in this bucket. Not too much, because it's probably at pretty low interest rates, and you're not making much money on it. Another time, we'll show you what the bank does with your money, and we'll show you how to do with your money what the bank does with your money. How you to do with your money to start doing that like the banks. Okay, we're going to talk about that. It's called infinite banking. We'll talk about that so you can even have this money working harder for you. Okay? Then we talked about provisional income on Social Security that limits your income when you're drawing Social Security, and up to 85% of your Social Security can be taxed. Go read about this and check this out. Call Social Security and say, hey, tell me about this provisional income. How does this work when I get full retirement age? Call and ask. Tell me what you find out. Tell me what you learn. The tax deferred bucket, typically IRAs, traditional IRAs, and employer retirement accounts, okay? The contributions are tax deductible, but when you go to use the money, it's treated like ordinary income. And in the future, your tax rates could be higher and cost you money, okay? The key is to understand your tax rates in the future. Do you want to take a guess or a gamble and have the government, the IRS, as your business partner when you retire? And they're setting tax rates that you have no control over. The best tax bracket to be in is 0. Okay, because when you retire, key deductions, as we talked about, are most likely not going to be around. Mortgage interest, child tax credits, retirement plans, contributions, and charity. They're not going to be as high as they were when you were working. Provisional income, up to half your Social Security benefits are counted as income. IRA distributions, pensions are counted as income, and then money you work for. Okay, and this is how much you make, and this is the percentage of your Social Security that could be taxed. For single people, you see, that's not a lot of money that you can make. For married people, it's not a lot of money, up to 44 grand. Okay? So you want to manage the income that's in this account, okay? And you want to get with a financial professional to figure out, okay, what are your deductions going to look like when you're in retirement? What kind of income are you going to have coming in through this account? And how much of the income can you offset with tax deductions so that you're in the 0 income tax bracket in this area? Does it make sense? You're going to have 3 to 6 months over here in this bucket. Then you have enough money coming in the tax deferred strategy so you can offset your income with tax deductible expenses so you don't pay any income tax. And then the third bucket, the tax advantage bucket, you can have as much coming through here as possible, because what's your tax on this bucket? 0. There are two tools for this primarily. One is the Roth IRA, and the other is cash value life insurance that takes advantage of tax rule 7702. And the reason why is you're maximizing your cash flow through tools that either use loans or the growth of your equity in a tax advantaged environment is what these two things do. And we want to maximize everything we can come out of there. And we also want to use passive income, like through real estate and other things that we have tax breaks against. Okay? But our goal is to be income tax free on a federal and state level, and then capital gains tax free. Does that make sense? So we're going to talk further about strategies, the Roth IRA and cash value life insurance. We're going to cover it lightly today, and then we're going to cover it again next week. So the tax advantage strategy to the Roth IRA. Now, there are some rules that come with it. You put the money in the Roth IRA after tax, and it grows. But then you've got the 59.5-year rule, which we'll cover in a second. The good thing, it has no impact on provisional income. So money that comes out of the Roth IRA doesn't count against that Social Security number. Okay? You can contribute after-tax money, but one of the downsides is it's got contribution limits. It changes by year. So look up the contribution limit for your Roth IRAs for the year coming up, 2024. And the other thing about contributions into an IRA, if you don't maximize your contributions during the year, the calendar year you're in, you can't go back and catch up later. Okay? If you miss the opportunity to max it out for that year, you just missed out on that opportunity. Roth IRAs also have income limits. Once you reach a certain income limit, you lose the tax benefits of the IRA. Okay? So, in a sense, the government is saying, we're going to help you, but not too much. Because if you start making too much money, we're going to take this tax break from you. So, think about that. Why would the government do that? If you make too much money, we're not going to give you this tax break. Because the government wants to collect taxes from you. You have to get a team together that can help you understand the tax law so that you can manage your way through it and do tax planning the way you do other planning. The Roth IRA has some liquidity constraints. It's got a 5-year rule, and you could be impacted by higher taxes in the future. Okay? So we're going to check that out. So the 5-year rule, it says, now if you do a Roth conversion, what does that mean? You've got a traditional IRA, and you're going to transition into a Roth IRA. Why? Because when you want to start taking money out of this, you don't want to pay tax on it. So you have to wait 5 years or until you're 59 and a half, whichever comes first, before you can touch the principal without tax and penalty. In other words, if you have your money in a regular IRA and you try to take it out before 59 and a half, you're going to pay regular income tax and a 10% penalty. So you don't get to switch that off when you switch over to a Roth IRA. You still have to abide by that till you hit the 59 and a half. And you've had it in there for 5 years. If you're already 59 and a half, when you make the conversion, you can touch the principal immediately, but you got to wait 5 years before you can touch any money that grew. So if you put 10,000 in and you got 20,000 in, the first 10,000 you can touch, but that next 10,000 that you earn by having investment growth or growth in your equity and your principal, you can't touch that for 5 years. Okay, that's what I meant about some liquidity. It has some liquidity limitations on it. Okay, so that's the 5-year rule. Get the book, read up on that. Okay, the 5-year rule, understand it. Okay, now here's the after-tax thing. Check this out. And what this is saying, here's Gary and Doug, and they're both in a Roth IRA, but there's no change in the tax rate. So tax rate at age 35 is 30%. Oh, let me go back. Tax rate is 30%. They're putting 5,000 in. But in the Roth IRA, you can't put in as much. But at 65, here's your value. Your 401k has 611,000 in. Why? Because you didn't pay tax on it. But this one, you paid it up front. But you're paying the tax here. So at the end, you end up with the same amount of money. If the tax rate stays the same, you end up with the same amount of money if you're in a 401k or a Roth IRA. Because you're going to end up paying the same amount of tax. It's just with the Roth IRA, you pay it up front, and the 401k, you pay on the back end. But let's say your tax rate changes by only 1%. Look how much money you lose, about $6,000. If it only changes by 1%, you lose $6,000. Do you think they changed the tax rates by only 1%? Probably not. Our taxes have been as high as 90% in the past. What if that tax rate goes up 10%? You just lost 60 grand out of your retirement. You know, think about that. If you're bringing home 50 grand a year during retirement and your tax bracket goes up 10%, that's 5 grand a year. If you stay retired for 20 years, that's $100,000 you just paid the government. Do you want to do that? Or do you want to understand how to get into this 0% tax bracket? Well, that's what we're here talking to you about, the power of zero. And then there's some constraints on the Roth IRA contributions, okay? If you're married filing jointly, your adjusted gross income has to be less than 189 grand. If you're younger than 50, you can put 5,500 in there a year. If you're older than 50, 6,500. Check this out, because these are a little old. So check this out and double check that these are right. For single, you gotta make less than 120 grand before you can start to use the IRA in total. And then the same contribution limits. So the money you put in is available for withdrawals anytime without penalty. But funds from growth are subject to tax and penalties on withdrawals prior to age 59 and a half. So you can always take the money out that you put in, but you can't take the money that grew until you're 59 and a half. Okay? So that's kind of how IRAs work. Now, what about a life insurance retirement plan? David McKnight calls it alert. I don't call it alert. I didn't come up with that frame, he did. But you set up the life insurance policy to maximize cash accumulation. Now, you buy life insurance for the death benefit. And as a life insurance professional, I always want to make sure my clients have the appropriate amount of life insurance, because that protects your income for your family. And life insurance now has things called living benefits on it, that if you get sick or hurt and you don't die, but it hurts your ability to work, you've got some coverage to help replace income, pay medical expenses, and other things, okay? But for the purpose of retirement, this is using life insurance because of its tax benefits. You want to set up the life insurance to minimize the death benefit and maximize the cash value that grows up into it, okay? Now, hear what I said, though. We want to make sure you have enough life insurance. And we don't want to set up something like this that hurts your ability to get all the life insurance you should have. First is we want to make sure you have enough life insurance so your lifestyle doesn't change should you or your spouse pass away. One or the other or both. The good thing about the alert plan, there's no contribution limits. It doesn't matter how much money you make. You can still fulfill the plan. There's no income limits as well, okay? There's very little legislative risk. I hate when I say no, but the reason is because the people who wrote the laws, they also have these plans. And if they change the laws, they'll be changing the laws on themselves. You also get multiple accumulation strategies. In other words, there's different places you can put your money to grow. Things that are within the insurance company that they develop, and there's growth strategies outside the insurance company developed by professionals in growing money, okay? So you have a lot of options to grow your money. So our goal is, and what we're going to talk about next time, we're going to look at a case study. We want to balance what you put into the Roth IRA and what you put into the life insurance plan. We want to balance those and show you why both of them make sense. And you say, well, life insurance is an investment vehicle. I didn't say it was. But it can be an effective retirement vehicle when you look at all the costs, okay, and you structure it right. And you minimize the expenses of the life insurance retirement plan. Okay, we can show you how to do that. Now, next week, we're going to go through Chapter 6, the tax sale of a lifetime. We're going to look at tax changes that were made in 2018 that are still hanging in until 2026. And then we're going to look at a case study. What does this actually look like in practice? And how do I begin to set myself up to pay zero income taxes during retirement? Does that make sense? To really look at how that tax-free bucket works, to look at the tax laws and see what the sweet spot is, and how to think about your taxes and what your tax bracket is, and then look at a case study of a real life person and how they're dealing with this, okay? So remember, share this program with your friends, your family, people that you care about, because taxes is your number one expense. Income taxes, real estate taxes, sales taxes, property taxes. Taxes is your number one expense. And you have to figure out a way to minimize your taxes if you want to maximize your financial freedom. So, share this with your friends, put questions in the chat so we can answer them for you, and I look forward to chatting with you next week, okay? Take care, guys. Bye-bye.